Upasna Bhardwaj, the economist at Kotak Mahindra Bank. Hi, Upasna. Thank you so much for joining us here on Market Sense. I really don't want to focus too much on the minutes because I think the press conference had taken care of all of that. We got the sense of unanimity during that press conference chaired by Urjit Patel as well. What I want to understand from you is that if you look at the rupee's movement, if you look at what's happening in the bond markets, where do you see the role of the Reserve Bank? Have you spotted it actually intervening? Are you expecting the Reserve Bank to maybe try and even curb liquidity?
Yes, I think having said all of that from the MPC minutes, clearly now the role of the Reserve Bank of India would be, very focused on, the two aspects, how rupee is moving. And we are hearing that RBI is probably anecdotally, intervening to prevent really sharp moves. And that's what they've done in the past as well, talking about volatility. But having said that, I think the magnitude of the move will be determined by global forces, and that is something which we'll have to keep note of. Globally, right now, as markets gradually begin to price in a much more a tighter monetary policy stance from the whole of developed markets, as the global recovery is happening in a much more synchronized fashion. Inflation numbers globally are surprising on the upside. So all in all, I think this is pointing towards a much more faster monetary policy withdrawal, monetary accommodation withdrawal from the developed markets, and that is something which will continue to provide keep a pressure on the emerging market currencies, and hence rupee will also continue to remain under pressure. Along with that, of course, for rupee, because India is a current account deficit economy, the fundamentals also will be important, because commodity prices overall have moved up significantly, and that also continues to put in pressure because of increasing pressure on current account deficit. So I think all in all, things are pointing towards a depreciation in the currency. It's all about how fast the move could be, and that is where I expect RBI's management of the FX moves or intervention policies to be focused on. So I think that's going to be playing a very important role in the sense of the magnitude of the move that we will see and in what period of time. But we are expecting that from henceforth, broadly, given the global conditions being adverse and the fact that our own balance of payments seems to be gradually turning on the negative side, we would be expecting a depreciation in the currency.
You've also seen the US Fed, if pardon me for putting it so crudely, throw the market off. Everyone's continuing to guess what's happening on that front. You've seen rising bond yields. They're pretty much stomping out the stock market rally as well. Are you expecting that kind of confusion to continue? Because back home, shouldn't Mint Street actually have clarity when it comes to the Reserve Bank and what the central bank is making of it, and now what the central exchequer also thinks of the fiscal deficit, etc.?
Yeah, I think globally, of course, I don't think the Federal Reserve has really thrown much of a surprise. I mean, they have been fairly consistent, and they have been telegraphing their intention that they would be gradually hiking rates as and when growth and inflation provides them the scope for. So I don't think really that there's too much of a surprise coming from that angle. Of course, we could be talking about a 3 or a 4 rate hike by the Fed. And of course, they've already started tightening their balance sheet in a very, very staggered and a well telegraphed manner. So I don't think that is really the reason why there has been so much of a sell-off in the global US Treasury markets. I think it's more about the fiscal slippage in the US and the excess supply. That is which is worrying the markets, and hence we are seeing the US Treasury yields surge as much. Of course, and also along with that inflation has surprised recently, and that is adding on to that. So that is translating across the globe. Globally, we are seeing that kind of a pressure on the bond markets, and that is further putting pressure in the Indian bond markets. But having said that, there are domestic factors. We have inflation, which is on the uptrend. We have fiscal slippage concerns. So all in all, we do have domestic factors which are just adding on to the already adverse global conditions. So in the absence of strong FPI inflows, of course, in the debt market, because utilization levels are already almost full, we don't have too much room, and hence from a demand supply perspective as well, right now we do not really see much room for a sharp, rally in the bond markets. More so, given the inflation and the fiscal concerns, it looks unlikely that we'll see a meaningful correction from these levels.
Right. Ma'am, can you just tell us that, it's more interesting to see what will be the tax cuts in US, what will be the sort of global recovery which will lead to rates being higher, rather than just the commentary of MPs, commentary which is coming from the Fed members?
Yeah, clearly, the expectations are, if you look at the Fed members' commentary, most of them are expecting that the growth is going to surprise them on the upside, given the fiscal measures that have been announced. So even though they have not zeroed in on numbers, but I think most of the members are expecting an upside to the growth expectations. So clearly, as and when the growth starts picking up to that extent, we will start expecting that the Fed members' dot plot itself is going to start reflecting that. As of now, of course, markets more or less have priced in a March and a June rate hike by the Fed. And beyond that, of course, we'll have to wait and see. Probably in the June FOMC, we would possibly see a shift in the dot plot, overall, and that could be incorporating the impact of the tax plans that have been announced. So at this point in time, maybe the FOMC members would prefer to wait before they really chalk out a plan for a fourth rate hike, or rather commit for a fourth rate hike at this point in time. But having said that, probably as we come closer to June meeting, that is when there will be more clarity on how growth is really panning out because of the fiscal stimulus, and hence is there any positive surprise on the upside on growth and the consequent impact on the increase in the rate hikes that we're talking about today. So I think there is some element of uncertainty, and that's the reason probably we do not expect Fed to right away commit for a fourth rate hike. They would want to wait and watch.